And of course, as everybody's been watching stocks, Jim, they've been watching the VIX as well. As tends to happen when stocks pull back, the VIX ticks up. Last week was an incredibly volatile week in terms of the swings in stocks, and it looks like it's not over.
Right. Well, that's our view. I mean, viewed in isolation, you might expect that this volatility event is either at or past the point of maximum intensity. We don't think so for a few reasons. First of all, it's worth looking at what happens with the distortion in the volatility surface in an environment like this. It doesn't happen very often. Spot VIX hovering around 22. It got up to around 22.50 intraday. Today, the VIX futures curve inverted all the way out to December, and then the spread between spot VIX and the 6-month future is its widest that we've seen, certainly over the 22 months of this low volatility regime.
So all of that means?
All of that means there's a massive distortion right here and now. Typically, it doesn't last very long. But there are other reasons that we think that it could last a little bit longer.
And they would be what?
They would be the fact that we viewed this as a cross-asset volatility event. It's not U.S. equities in a vacuum. If you look at the broadest measures of volatility across asset classes, across geographies, they're headed higher, but they're not at levels that we would believe that the broad event for equities are over. Specifically, emerging market volatility, higher, not high enough, and that's comparing it to the taper tantrum of June, July of 2013. The global financial stress index, similar. And if you want even a more straightforward metric to watch, EEM, the ETF, so the emerging market ETF, implied volatility there around 21. A year ago, it peaked out around 28, 29. So we just see more upside in other asset classes, other geographies, therefore risk to U.S. equities.
And so you're looking to play that EEM option in particular, and you're more negative on the EEM itself.
Exactly. We still think there has to be upside in emerging market currency volatility as well. EEM. EM is actually bouncing today. Brazil's ripping to the upside because of first-round election results there. But yes, over the very short term, and to be clear, we think this now plays out over the next couple of weeks, we would want to come in and buy EEM puts. You can go out to the October 31st expiry, buy 40.5 strike puts outright. If EEM comes in, if declines from here, you would benefit both from that directionally and also from the higher implied volatility that we think we need to see before this is over.
So amidst all of this concern geopolitically, economically, we've got earnings coming here in the United States. And we're going to start with the financial earnings. Of course, that's usually what kind of kicks it off. You're looking at the XLF, which is one of the financial ETFs, the Financial Select SPDR in particular, as a way to sort of play this. And what's your outlook for financial earnings?
So we cover financials broadly constructive on the group. JP Morgan, Wells Fargo, Citi all report tomorrow morning. Now, it's important to note the risk we see on the macro perspective is not mutually exclusive relative to single stocks. We still want to be adding long exposure to individual stocks, financials in this case, especially where the volatility surface is distorted. So we want to use XLF, the broad ETF. We want to go all the way out to January. And what we want to do is we want to sell a 20-strike put. We want to buy a 24-strike call. And you can do that essentially for even. Critically, there's a 10 volatility point spread between those two contracts. That's something that's very attractive. So you are selling skew. You're taking advantage of the fact that investors into this sell-off are coming up and bidding up the price of puts. And that's something we want to exploit to gradually add long directional exposure.